Welcome to this morning's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. So this week's topic, we're going to be talking about advanced tax strategies, right? So we're going to talk a little bit more, a little farther down in the process than what we have talked about previously. We talked a little bit about deductions and credits in the last couple of weeks, but let's talk about ways that we can start to integrate those things together, right? So most of you, if you're listening, you probably have a pretty good sized tax bill and you're wondering are there ways for me to cut that tax bill, right? Can I put a dent in that tax bill? And that's what I want to talk about today. See if we can find ways for you to really save some actual tax dollars, put some money back in your pocket, maybe again, for yourself personally or to advance your business, right? So what if you could put, 25% reduction in your tax bill, or even a 50%, right? It could be big dollars for you. So let's see if we can find ways for you to save some additional money. So we're going to talk more about credits and deductions. We've done that before, but again, a little bit deeper. We're going to talk about Section 179. You've heard people refer to that. Or accelerated depreciation or bonus depreciation, all kind of typically the same terms that are going to be used interchangeably. And then we're also going to talk about when you can kind of time the dollars you're bringing in, your income or your expenses, right? So, all right, let's get started. So why does this matter, right? We always talk about this. Why do these topics matter? So your basic deductions are going to be great for you, right? They're going to definitely save you some money, but when you start to look at some of these advanced strategies and you start to combine them, if you can, you really have the opportunity to potentially multiply your savings. It's not just reducing your taxable income, but you could be reducing your taxable income as well as reducing the actual total income tax. So again, you have the ability now to start to aggregate some of these things together, which is what we're going to talk about. The really big thing is you need to plan ahead. Running out on December 27th to buy a pickup truck to get your depreciation is not tax strategy. Now, if you need that vehicle and it's part of an overall growth strategy, you're looking to hire another team member that will be utilizing this vehicle, then that becomes part of an overall business strategy. And then you also integrate the tax strategy in with it. So again, you're not trying to take advantage of things in the last week of December. Really, when you're doing your planning in December for the next calendar or fiscal year for yourself, that's where you're starting to develop out what it is that you're going to do from a tax perspective. What credits and deductions can you take advantage of? For example, do you actually need that vehicle? Yes, I do. I'm hiring a person. I'm going to bring them in, in April. Well, do you need to buy a truck in December? Probably not. So it makes more sense. You're buying it in April. You're taking advantage of it in, the next calendar year. Again, it's all part of planning. It's all part of a proactive, strategy to reduce your taxes. It can't be reactive. You can't be scrambling at year end. Don't call your CPA the first week of January and ask them what you can do. You're definitely not really doing much for the prior year. You can do something for the year that you're in, but it really comes down to you have to be doing the planning. And again, there are going to be certain things in construction that you will, in some cases, have the ability to have maybe a bigger impact on your tax savings because we're talking about and we're using things like very heavy equipment, right? Large project cycles in your construction and your trade. So there are different ways to play with that, all right? And that's kind of the little bit of what we're going to talk about today. So we're going to combine our credits and our deductions, right? So let's go over one more time. Credits, those are going to reduce your tax bill dollar for dollar. If you have a tax bill of $50,000 and you have a $10,000 credit, your tax bill now is going to be $40,000. It's a dollar for dollar credit. Your deductions is simply going to reduce your taxable income. So if your taxable income is $500,000 and you have a $50,000 deduction, your taxable income now is going to be $450,000, right? And then the tax is going to be calculated on that. So they're two different things and they're handled differently. And you want to make sure we definitely don't want to use those terms as interchangeable because they're not the same thing. So, for example, you could potentially claim the research and development credit, especially in construction, where now if you're utilizing new advanced ways of building, new advanced products, new techniques for installing those products, you potentially could be eligible for an R&D credit, right? Research and development. So there are going to be expenses associated with that that will be used in developing out what that total credit will be, on top of the fact that you are allowed to deduct the expenses, right? So you're combining the two things together, getting a little bit more bang for your buck. So you want to make sure that you are having a conversation with your tax professional, whether it be a CPA or an EA. Look to see if there are, two ways to kind of skin this cat, right? Is there a credit and a deduction? Do they go together? Do we have an opportunity to take advantage of things and kind of get more bang for our buck? But you don't want to wait to do this in February once the year is gone. Sometimes you don't necessarily have as much leeway with playing with things and getting to take advantage of credits and additional deductions, etc. So this is part of that year-end planning you're doing for the next year, right? What can I take advantage of next year so that you can take full advantage of it? You're not trying to figure out what your tax plan is the last week of December, right? That's definitely not going to get you the biggest bang. You really want to do this at the minimum a year in advance so you can fully take advantage of a full credit as well as full dollars in deductions. So the really big kind of needle mover, especially in construction, is going to be depreciation. So Section 179, right, is where we're going to depreciate everything all in the year that the asset is acquired. Or there might be bonus depreciations. It's going to depend. It's going to depend on what you've purchased, when you've purchased it, what type of business you. So these are going to be two things that, again, we don't want to use these interchangeably because they aren't exactly the same thing, right? So we want to make sure we understand what they are, but also maximize what they are. So Section 179 is simply going to be an immediate expense for that, expense deduction for that equipment you've acquired, the vehicle that you've acquired, right? Even sometimes if some of you, I know some of the softwares that you're using in construction, the project management softwares can in fact be pretty expensive, especially if you're buying a product that you're installing. So again, those are things that you could potentially take the deduction for all in the year that you have acquired those things. Now, bonus depreciation is going to be something that there are going to be certain things that you may not be able to Section 179. So I want to make sure that you're clear on that. For example, and we get this question a lot, especially in construction, when you're going out and you're acquiring vehicles, your vehicles, in order to qualify for Section 179, have to be of a specific weight or a specific kind class of vehicle. For example, your typical on the street pickup truck, if it does not meet a certain weight requirement, you can't 179 it. What you can do is you can get a certain amount of depreciation on it, and you might be eligible for bonus depreciation. You wouldn't necessarily be able to expense the entire thing, but again, now you're not losing out completely. You're just taking advantage of buying, that deduction plus maybe getting that extra, right? And then as, again, you're not getting to depreciate the whole thing, but you're getting to depreciate a large portion of it. It's going to be on the front end of acquiring that vehicle. And then keep in mind on the back end of that, or the back end of that equipment, it's going to be less and less depreciation. So that number gets smaller. So basically you're trying to front end it in that first year that you have it. So again, we're going to use this vehicle, this truck. So your standard Ford F-150 or your Dodge Ram, all of those standard, we'll call those street type of pickup trucks, that vehicle would not qualify for 179. It's going to probably qualify for regular depreciation and bonus, but you wouldn't be able to 179 it because it doesn't weigh more than 6,000 pounds. Now, once you get up into the larger class, the 250 class of the Fords, the 2500 in the Rams, the 3,500, the 350, right? These very large vehicles, there you have a little more opportunity to choose or get accelerated depreciations. So that's one thing you need to be wary of and aware of when you're making those purchases. Are they considered a street vehicle? Now, if you're acquiring a box truck, right, that is clearly going to be used for your business. So that you would be able to 179, but that Ford F-150 that you're going to purchase or you're thinking of purchasing may not get all of the accelerated that you want out of it because it just doesn't meet the classification. So you want to make sure that you're aware of what you can get out of that. For example, and I'm using this as a very general item, it's because it's so common. It is a common kind of lever we pull on, especially in construction. There are so many, vehicles is an easy way, to get yourself that additional expense. You just want to be mindful of the fact that if it's of a certain size, then it may not meet the requirements. Another one is an example. We did with the credit that did go away in 2025, we had a number of clients that were acquiring the Teslas. There was an additional tax credit there for acquiring a Tesla, but if you purchase the actual car, that didn't qualify for your 179 because it didn't meet the weight requirements. But if you bought a Cybertruck, that in fact did meet the weight requirements. So again, a couple different things. You just need to be strategic about what it is you're acquiring, what do you need, but be aware that you're still eligible for certain things. It's just you may not be getting the maximum that you think that you are. So again, you're always going to be investing in tools, trucks, very large pieces of equipment and machinery. So again, depreciation tends to be that one of the first levers that we use in order to get you some tax savings. So, use it in a way that makes sense. Are you being strategic about that asset acquisition, or are you just running out at year end and buying pickup trucks just to get a tax deduction? Because that may not be the best thing for you either. If you're planning on when you're acquiring these things, that really is part of that is real tax planning. Again, running out on those last days of the year trying to get those trucks for depreciation, that's not real tax planning, right? Thinking about when you're going to need them, are you replacing vehicles, those kinds of things. So again, I use that pretty, as a common item to think about because it's just so common in construction. Again, it's one of the first things that we go after when we're looking for tax savings. So let's talk about timing of your income and then timing of your expenses. So what exactly does that mean? For many of you that are, that we are talking to here, many of you, if not most of you, are going to be what is called cash basis for tax purposes. It's dollars in and dollars out. So you might be tracking your financials, and you probably are tracking your financials from an accrual standpoint. So when you do the work, when you incur the expense, but for tax purposes, it's dollars in, dollars out, right? So can you shift an expense into this year, right? And could you defer some of that income, right? Maybe it's possible that you have the ability to say, oh, okay, well, maybe, client, you get a couple more days to pay, and that gets your payment into the next year, right? Are you moving expenses into one year and moving income into another? This could potentially reduce your tax bill. What I want to do is kind of preface that with when you start to kind of front load expenses and try and keep them in one year, and then you're pushing income into another year, the challenge and kind of the game at that point becomes how much income did I push into the first year, or how much expense did I push into that first year, and how much expense is in that second one? Do I have no expense to offset that income that I have in that next year? I got my tax savings this year, but I might be swinging the pendulum in the other direction where I'm getting my income in the next year, but I don't have any expense to offset that. So you want to make sure that you're clear about, where that, again, it becomes a little bit of a game. You're playing with it, but you want to make sure that you are aware that throwing all the expense into this year and having income in the next may not be the best thing for you. So again, you want to look at that and see how much you can move the needle without moving the needle so dramatically that, again, you get a ton of expense in this year, you have very low taxable income, but then it swings in the other direction next year, you have very little expense and all your income is there. And now you've got huge swings in your taxable income year over year. So again, we want you to save money, but is it at the cost of swinging all of that income into the next year? So you have to be careful with that. So again, what can you do? You can prepay your vendor invoices if you'd like. That can help you. You can stock up on supplies that you know that you're going to use. You could potentially delay an invoice. So instead of sending out invoices at the beginning of December, with the with the indication that you'll probably maybe get paid by the end of December, maybe you're pushing those invoices to the end of December and you're going to get paid in January, right? Can you move that around? It does give you a little bit of opportunity there. So again, you have the ability to kind of play with it. As with anything else, timing is great for tax purposes. You also want to now think about, we're playing the tax game, but what is this doing to my cash flow? If I've pushed a lot of expense into this year and I'm pushing my income into the next, do I have the dollars to pay these things? Because you have to pay them. Can't incur them. You have to pay them if you're cash basis. So if that's the case, are you front loading expenses? Do you have the cash to do that? Especially if you're not getting your income or your dollars in until the next calendar year, right? So it's a strategy. Your shifting is a strategy, but you have to be very clear about what it's doing. Are you getting tax savings at the cost of damaging or hurting your cash flow? Where exactly, where do you need to fall? Where do you need to land on that for it to make sense? Like anything else, make sure that you talk to your CPA or your EA. What is the best way to do the timing so that it works for you, so that it not only gets you tax savings, but it also maintains your cash flow. It doesn't damage it. You're not at a point where you're waiting to get paid, and now you've got very little dollars and you're waiting to get paid. So it's a strategy, but it needs to be timed in a specific way so that it doesn't hurt your overall business. Okay. These are all great strategies, but it has to be considered in that overall picture, right? It's not just, again, I'm going to run out at year end, I'm going to buy a vehicle to get the depreciation, but you have a cash flow problem. And the reality is when that first payment comes due in January, early February, do you have the cash flow to actually make the tax payment, and to actually make that first loan payment on that truck that you've run out at year end to acquire? You needed or thought you needed depreciation or you wanted it for the tax savings, but at what? Do you have a cash flow problem? Is there one more thing to throw into that cash flow problem? Because now you've got another vehicle, and unfortunately these vehicles are so crazy expensive. The notes on them can cost you upwards of $1,200-$1,300 a month. So again, right, this is all part of an overall plan. This isn't just save me some tax dollars. No, like what exactly? We want you to save tax dollars, but it can't be at the expense of your overall operations or your cash flow. So what are some of the things that you can actually do, right? What are a couple of actionable takeaways from this that you can do for yourself? So you're going to want to pair your credits and your deductions together, right? Don't assume that you can only claim one or the other, right? Find out if there's an opportunity, to combine them together, get one and the other. If you can, you really could get some potential, like kind of bang out of that and some significant tax savings. Look at your equipment needs, but do not wait until the last week of December in order to do it, right? Is it possible to leverage it and make it an acquisition before year end to get that deduction? Or, there are times where you may actually want the deduction next year. Why? Because you have some overall plans and there's an expectation of, you have additional projects and additional income coming in. So you may, in fact, want to move that expense to next year and not this year, right? So you're reviewing your needs, but you're considering the acquisition based on your needs and not, oh, I've got to save X dollars this year, so I'm going to run out and buy a vehicle, right? It really should be part of an overall strategic business decision. Plan your cash flow, right? If you are accelerating expenses or you're deferring your income, is it at the expense of your cash flow? Are you, going to find yourself cash strapped and not have the cash, that you had, and now you're waiting to get paid, right? You don't want to, again, you want to take advantage of the timing as much as you can, but again, at what expense? At the expense of having no cash for 2 or 3 weeks while you're waiting to get paid? Not necessarily the best and most strategic business decision. So again, is the timing a good strategic business decision? And as always, please talk to your CPA, your EA, run scenarios with them. You do not want to find out the hard way that you've set yourself up and you've in fact altered your cash flow for a period, and now you're wondering, okay, when are we going to get paid next, right? Again, tax savings is wonderful, but at what expense? Expense of having no cash for 3 weeks in the middle of January? That can be scary. So talk through all of these scenarios with your CPA, especially when you're doing your planning, your overall business and strategic planning, so that in advance. That you're going to do some of this. We're going to stuff expenses in 1 year and then we're going to wait to get paid in the other year, right? It's part of an overall plan. It's not just done to be done. So let's kind of recap what we talked about today. You can absolutely combine your strategies, right? And that can potentially get you some incredible savings. So just remember, you have the ability in some cases to combine credits and deductions together. Don't wait until tax season to do your tax planning for the prior year. Once the year is closed, it's in some cases is dead and buried, and it's really hard to go back and find savings after the fact. It's a lot easier to plan the savings in when you're planning out the year. So instead of planning your tax savings in December for the current year, let's plan your tax savings for the next year. You'll get more benefit out of your tax planning. And next week is going to be the fourth and final week of our tax series. So it's going to be, let's see, the topic is tax ready and stress free. Ooh, all right. So your year-end game plan. So we're going to talk about how to plan for that year-end, because that's going to be the most important thing. Again, you're not waiting till the last minute. You're doing a plan in advance. So if we'd always love to hear from you. Drop any questions or comments into the comments below. We'll get back to you as quickly as we can. As always, I look forward to seeing you here. Follow us here on Facebook, YouTube, Instagram, and LinkedIn. We are at The Construction CPA on all. I look forward to seeing you every week, and we'll see you next week.